Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And what I'd like to talk about in this episode is how to manage cash flow through the coronavirus pandemic. And it's something that a lot of clients and people that I've been speaking to haven't had to do previously in their life. And something I've been talking about not only with clients, but through other presentations and podcast interviews that I've been doing, which will be coming out over the coming weeks and months. Cash flow management is without a doubt the cornerstone of successful wealth accumulation. So it really doesn't matter how much you earn. If you can't manage cash flow effectively, then you're probably unlikely to be successful with building wealth. And I've seen clients with $1 million plus incomes with very little wealth to show for it. Conversely, I've seen clients or people with very modest income levels but very good cash flow management, and they've successfully accumulated a lot of wealth. So a large income is not a magic bullet to being successful with wealth accumulation. In fact, I actually think having a large income can be a negative, because I think it can potentially give you this false sense of comfort that you actually don't need to worry about cash flow because you've got heaps of income and surely you can't spend it all, which is definitely not the case. And, I've seen situations where clients have a very large income and are just so surprised that they don't have any money left over to invest. The topic of cash flow management can bring up painful connotations. People can think that what it means is eliminating all expenditure on all the fun things in life, and it being dreary and painful and, all those sorts of things. Well, really, that's often not the case. In fact, in almost probably 99 times out of 100, it's not the case. And the aim of best practice cash flow management is really to eliminate unconscious expenditure. You see, there's conscious and unconscious expenditure, and people rarely make consciously bad decisions. If I said to you, would you like to spend $30,000 a year on your gardener? Most people are going to say, no way, Stuart. Gardening's important, but not even close to that important. So therefore, what tends to happen is that we make unconscious decisions with our expenditure. And sometimes they can be in very small amounts, but those unconscious decisions can be regular, many a day, for example, over a long period of time. And it's quite insidious. That way we think, we're not really spending, I'm living a lavish lifestyle, I'm not spending things, big ticket items, those sorts of things, but I don't have any money left over at the end of the week, fortnightly or month. And so by eliminating the unconscious expenditure, not only saves you money, but it's likely that it won't have any impact on your standard of living. So that's the good news, is that good cash flow management doesn't have to translate into a deterioration of your standard of living. And the best way to eliminate unconscious expenditure is to track your discretionary expenditure at a total level over either a week, fortnight or month, depending on what your pay cycle is and how easy it is to track these items. You don't have to, another bit of good news is you don't have to track every single expense, just very much at a high level. So I tend to allocate expenditure into 7 categories, and these categories are listed in the show notes and on the blog on the website as per usual, so you don't have to necessarily commit these to memory. But there's 3 non-discretionary expenses. The first category is financial commitments, and that can include rent and mortgages, car lease, school fees, child support, childcare, I should say, those sorts of things. The second category is utilities, pretty self-explanatory, gas, electricity rates, etc. And the third is health and education. So that can be health insurance, medical expenses, and those sorts of things. They're non-discretionary expenses in that they tend to be fixed. It's very difficult to overspend in those categories, and and that when people are kind of leaking or cash flow overspending money, it tends not to be in any of those categories. So that's the first three. Then the next four categories to make up the total seven, what I would call discretionary or mainly discretionary expenses. So the first category there is shopping and transport. So that really includes food, clothing, beauty, petrol, car maintenance, public transport expenses. The next one is then entertainment. So they're spending on annual holidays, gifts, eating out. The last two categories are either cash or other. So cash is really just withdrawals from the ATM. And you can't manage what you can't measure, and you can't measure cash expenditure. So try and minimise cash withdrawals and use either a credit card or FPOS, PayPass and so forth. Very easy these days, and obviously during the pandemic situation, it's a better way of making payment. And then other is really a catch-all category. But those four items, which are, as I said, shopping, transport, entertainment, cash and other, are what I would refer to as discretionary expenditure. And that's where, if you are overexpending, that's exactly where it's likely happening. So the best thing to do then is to establish two accounts. The first account, which we'll call the savings account, would receive your salary income, rental income from investment properties and so forth. So all the income would go into this savings account. That would typically be your offset account that's linked to your home loan, or if you don't have a home loan, another investment loan. And you would pay all expenses from the first three categories. So that is the non-discretionary items, financial commitments, utilities and health and education, from that savings account. Then what you need to do is establish a secondary account, which we'll call the spending account. And you should then transfer a set amount each month, fortnight or week, depending on how you're tracking things, into that spending account. And you should pay all discretionary expenses from that spending account, including shopping, transport, entertainment, cash, and other, as I've previously explained. You need to set yourself a budget, and that could be, let's say, $2,000 a month, or it could be something considerably more than that, whatever it is. And then if you're coming towards the end of the month and you've got $500 left in that account, you've done well. If you've got zero left in the account halfway through the month, you haven't done as well. And I've given a diagram which I've extracted from my latest book, Rules of the Lending Game, to depict how that account structure works. And it allows you at a very high level to sort of manage the expenditure levels and also course correct after a very short period of time. So in our experience, merely setting up this banking structure is almost certainly likely to result in a reduction of expenditure without any negative consequences in terms of standard of living. But most importantly, it will allow you to have a very good track of your cash flow on a periodical basis. Again, whether that's every week, fortnight or month, will depend on your situation. But also we can use the lockdown to kind of reset our spending habits because unconscious behaviour tends to be habitual. And so breaking that habit tends to break that unconscious activity. And the pandemic shutdown might help people kind of achieve this to kind of reset their spending habits. If you run out of money from your spending account halfway through the period or partway through the period, whether that again is a week or fortnight or month, clearly that means you've spent too much, you've spent more than your budget. And essentially what you'll need to do is just have a closer look at your spending habits, which means going through that period and then allocating the expenses out amongst those categories, so shopping, transport, entertainment, cash and other, as I've previously explained, and identifying, where this over expenditure is occurring. If it is occurring in a conscious category, it's a conscious expenditure, then you can, my advice is to either reduce the amount per transaction or reduce the regularity of transactions. So let me explain that. If, for example, you love eating out, that's something you really enjoy to do as a family or with your partner, and if you eliminated that, that is eating out, Obviously, it's been forced upon us over the last few weeks and months, but as a permanent thing, that's going to have a real negative impact on your standard of living. So therefore, what you can either do is reduce the spend per time you eat out. So go to cheaper restaurants, order a cheaper bottle of wine or have a glass of wine. Or if you really like fine dining, for example, you don't want to compromise on quality, then reduce the regularity. So instead of eating out once per week, eat out once per month or once per every couple of months, for example. The temptation, clearly, once people start to become aware of cash flow management, is to try and eliminate these levels of expenditure, these types of expenditure in totality. So they might say, look, we're not going to eat out for 6 months now. But I would caution people from doing that because it's rarely sustainable. Remember, the aim is to try and build good cash flow management practices on a permanent basis, not a temporary basis. And, not eating out for the rest of your life, probably, particularly if you enjoy it, is probably not going to be something that's going to be sustainable, as I said. Of course, there's some technology that you can use to help you do this. So probably the most popular app is Pocketbook. And I've got a link in the show notes and on the blog on the website. And essentially what it does is it automatically downloads your transactions from your bank account and then learns what you're spending money on and then automatically allocates that to predetermined categories. And you can have a budget for each category and then a notification when you get close to exceeding that budget. If you're happy to do it, that's obviously even better. Cash flow management, but in my view, as long as you're tracking as a high level and you're comfortable with that expenditure amount, you don't need to get into that sort of granular level of detail. And again, you've got to ask yourself whether that's going to be sustainable. It's not going to suit everyone. For some people, love to have that level of transparency over their finances, and that's great. But as I said, it's not going to suit everyone. Of course, there's two big advantages of improved cash flow management. The first one is obviously you reduce your waste and therefore you've got more money left over to invest, and that's an obvious advantage. But the other advantage is that it gives you much better data to base financial decisions on. So, for example, if we're contemplating helping a client upgrade their home and we really want to extend the budget as far as we can, and we're confident we have a good understanding of what their cash flow looks like, then we're going to be in a better position to give better quality advice. However, if we don't have a good understanding of what a client's cash flow looks like, or we believe they don't have a good handle on it, then we're probably going to be more conservative than aggressive when giving our advice. So it really does aid that decision making. And, in my experience, 90% or more of people really don't do any kind of cash flow management. So don't feel bad if you fall into that category. A lot of people aren't doing these sorts of basic things, and mainly because they haven't been taught and haven't been shown. And the thing is, when I ask people, how much do you spend? Most people, particularly ones that aren't tracking it, are very, very bad at forecasting or guesstimating how much they spend. And it doesn't tend to either be underestimating or overestimating. It's a hodgepodge of just bad estimation. So until you start tracking these things, you'll be surprised by the amount, either delighted or put off or disappointed by how much you're spending. But the point is, what you don't measure, you can't manage, and that's really the point. And lastly, if I leave you with the fact that good cash flow management doesn't have to be painful. It can be an actually enjoyable and rewarding and empowering process. And it's really just about having those two bank accounts, managing at a high level, and that would take you 90% of the way. If you get to the point where you master your cash flow and want to start talking about, what next, how do you invest that surplus, that newfound surplus in cash flow, of course, don't hesitate to reach out. But until next week, that's it from me. Bye for now.